And here's the question. In the last 50 years, the United States has taken a policy of benign neglect toward the foreign exchange value of the U.S. dollar. That the price of the U.S. dollar has been determined by some combination of market forces and by the intervention of foreign central banks. Some foreign central banks have accumulated what some of us would consider an obscenely high level of foreign exchange reserves. Some countries now have what I consider to be an extraordinarily large current account surplus, and some countries have to close the system, and that country is primarily the United States. Now, one part of the written paper deals with the decision to close the gold window. The alternative to closing the gold window would have been to have increased the U.S. dollar price of gold to $100 or to $140. The analogy, the historic analogy, is the decision that the United States made in 1934 to increase the U.S. dollar price of gold from $20.67 to $35 an ounce. The system of fixed exchange rates was more or less maintained. That increase in the dollar price of gold led to a golden avalanche, and the United States developed a trade surplus as a result of the flow of gold to the United States. I'm going to skip that part of the paper and to go to what I would call the floating exchange rate system. So if we could go to the overhead, which begins the case for flexible exchange rates. Do I control this?
I'm there.
The case for flexible, there we go. Perfect. Oh, you're in charge.
I'm in charge. I'm watching your slides.
Oh, that's marvelous. I hope this is great. Right.
Women are always in charge.
So here's what I would call the positive case for flexible exchange rates, and these are the arguments that are summarized in the McDougall book on flexible exchange rates. One of the arguments is the price of the currencies would approximate the price of the currency in the exchange market would approximate the price that we would have predicted from differences in inflation rates. A second positive claim was that changes in the prices of the currencies would be gradual. The third positive claim is that each country would be more fully insulated from shocks in other countries. Another positive claim was that there would be fewer currency crises. And the final is that the demand for international reserves would decline because countries would believe that they could rely on changes in the price of the currency if they would otherwise have a trade deficit. Now, if we go to the scorecard on these countries, there's just no empirical support. There's just none whatsoever. As an exercise in forecasting, the proponents of flexible exchange rates deserve a 0 or a negative number. And if we ask the question, why is the case for flexible exchange rates intellectually bankrupt, then the answer is the proponents of floating exchange rates believed that, ignored the capital account, simply ignored the capital account. And when the critics of flexible exchange rates pointed to let's call it a aberration, the proponents would sort of say special case, unlikely to be repeated. But in the short run, the changes in investor demand for foreign currencies drive the exchange rate. And we see that. This is what Sigurd is going to talk about today. We see that brilliantly today. It's the leads and lags or political factors which lead to these immense changes in the market prices of currencies relative to the prices that we would have predicted from the differences in inflation differential. Now, one of the points that I make in the paper is, how does a country, we want the overhead.
I have it. It's on.
How does this marvelous country, Iceland, adjust to an increase in its capital account surplus? And the answer is that the domestic economy has to adjust. So assume that the world demands more Icelandic securities. The price of Icelandic krona will have to adjust, will have to increase, but much more importantly, the prices of assets in Iceland soar, just soar. In this case, they went up by a factor of 10. This is implicitly what is now happening in the United States, despite the dated news on what is happening in stock prices, and we can come back from it. Come back to that later. This is what happened to the United States between 2003 and 2007. There was an autonomous increase in the U.S. capital account surplus. We needed to have the markets adjusted to ensure that we had a counterpart increase in the current account deficit. The increase in the current account deficit arose from the surge in U.S. house prices. Then the foreign demand for U.S. dollar securities declined, and we had this massive crash. So now let's go to this overhead. What are the costs to the United States? Now there's a literature out there that says the foreign demand for U.S. securities is because Americans save too little. I think this is bullshit. Every time there's an increase in the foreign demand for U.S. securities, U.S. asset, that's a scientific term. Every time the foreign demand for U.S. securities increases, U.S. asset prices increase. That's the adjustment process. So the increase in the flow of foreign savings to the United States now displaces U.S. savings. The second is that as a result of the cumulative increase in the current account deficit, we've lost 3 million manufacturing jobs. Could be 4 million, it could be 2 million, but it's an immense loss of relatively, in some cases, high-paying manufacturing jobs. A third cost is that the high price of the dollar has depressed the profit rate in the production of tradables. And the fourth cost is that the variability of the foreign demand for U.S. dollar securities means that we have much more of a boom and a bust cycle. So let me conclude. We now go to the last slide. The increase in U.S. international indebtedness has led to consumption booms. We've lost a tremendous number of manufacturing jobs. The rate of U.S. economic growth has been slower because we've had a lower rate of investment. Closing the gold window, I believe, was a cost to many of our major trading partners, and we, incidentally, are the world's largest holder of gold, so we essentially reduced the effectiveness of gold as an international asset. And I think very importantly, because of the foreign demand for US dollars, the dollar has at a higher price. The overvaluation of the dollar has led to problems in many traditional American manufacturing industries, and that has led to a change in the stance of US trade policy from being more open to being more closed. Thank you very much.
All right, so I thought what would be useful at this point is to look at some of the data. What I did is to look at imbalances, current account imbalances in a group of 18 countries. There's this historical data set going back to about 1870 by Djorta, I can never pronounce his name, Shularek and Taylor. And it has data on current account surpluses and deficits and GDP, amongst many other variables. So the empirical prediction of Bob's talk, I think, is that in the 70s, after the collapse of Bretton Woods, there would have been rising current account deficits and surpluses caused by capital flows. So what I did is, can you see this? Take data from 1950 to 2020. And for the 18 countries where you have current account surpluses as a ratio to GDP for each country, so 18 observations for each year, and to do a box plot. So the box plot, is this a pointer on this?
No, yeah.
So the box has 50% observations. Then the bars above and below should be the top and the bottom observation. The dots are the outliers. And so what you see is the dispersion of current account surpluses in this group of 18 countries. And you see in 1950, it's quite compressed. In 1960, it's compressed. In 1970, there's a slight increase in dispersion. But then you can see this increased dispersion over time during the post-Bretton Woods period, and some huge outliers. So that, like in 2000, the outliers it's Norway and Switzerland with massive surpluses, Portugal with a massive deficit. So this first stylized fact is that the dispersion of the current account has been increasing. That may have many reasons. I just thought of this. One is a fiscal policy. This twin deficit idea. If some countries have public deficits and other surpluses, if that is increasing, the differences are increasing over time. One is differences in monetary policy, if interest rates diverge more than before. But then we got Bob Aliber's idea, I think, that capital flows after the collapse of Bretton Woods from surplus countries to deficit countries cause these current account imbalances. So the capital surplus countries export their capital to the capital import countries, creating overvalued exchange rates and an increase in asset prices, which then causes them to have current account deficits. So that's what brought us together here when Iceland crashed in 2008. So I didn't know what was going on, so I called Bob Aliber because he's seen so many countries crash. And he liked the opportunity to come, and at night I would call him and he would tell me what was going on, and it was a big learning experience. And then Sigga spent 3 years studying the crash afterwards for the parliamentary committee. All right, so the idea is it capital flows. And so what I did is I took the data on the 18 countries, observation from 1950 to 2020. So you have this matrix. So it's 18 by 17 matrix. And to summarize the information in it, I calculated the principal components of this matrix. And the first component here explains 36% of the variation in the matrix. And then when I look at the eigenvector for the first principal component, you see the blue and the orange numbers. I can see two groups. So one group has the United States, the United Kingdom, Australia, Spain, Portugal. They all have a minus number. And then there's another group of countries, Norway, Netherlands, Japan, Germany, Finland, Denmark, Canada with a plus. So these are the two groups. So they have opposite signs in the eigenvector. So that what comes out of that is that if I plot this principal component, it's like this. There's not much happening until about 1980, and then it falls. And this is like 36% of the variation over time in this matrix of current account surpluses. And what it captures is the following development. That what we have after the collapse of Bretton Woods is the emergence of current account surplus countries. So there I plotted 4. Netherlands, you see rising current account surpluses. Germany with rising current account surpluses. And then the Scandinavians, Denmark, and Sweden. I could have put Norway there. So the Scandinavians and Northern Europeans have these big surpluses. And then there are the corresponding deficit countries. So the United Kingdom. So this tends to be the English-speaking world here. The United Kingdom, the United States is the biggest deficit country. It absorbs the capital surpluses of a wide array of surplus countries. And so you have this pattern after the collapse of Bretton Woods is the emergence of Northern Europe as current account surplus countries and capital account deficit countries. And the US, UK, Australia as deficit countries, so current account deficit countries. Now, if we look at a similar matrix for government budget surpluses, so we have, again, 18 countries, 70 observations. And so could it be that the US and the UK just have big budget deficits, government budget deficits, and the Northern Europeans' budget surpluses? And there's no such pattern there. This is not happening. If you look at the eigenvector, there's no way that's the explanation. So here are the 3 principal components. I couldn't see anything coming out of this. Then if you look at the yield on long government bonds, then what comes out is that there's this, the interest rates on long government bonds move together across countries. So the first principal component is like 78% of the variation in the data. So I guess what's happening, the US sets the tone for the rest of the world. So when the US tightens, the rest of the world tightens, and the yields correlate highly across countries. So here, this is the first principal component for the yield on government bonds. So it peaks in the 80s and has been declining ever since. So this is the downward trend in interest rates since the 1980s. So the differences in the yield across countries are not the explanation for the increased dispersion of current account deficits. So what we, I think, find here that it's like the early 70s are like there's a German word, Zeitenwende, is a change of, see, I know some German. So it's one epoch comes to an end and another one begins. So it was the epoch when the fast growth in Europe came to an end in the early 70s. And it's also the beginning of an epoch with rising current account imbalances. And so the story that Bob Oliver told is consistent with these observations, that the emergence of capital flows, free capital mobility in a system of flexible exchange rates. Post-Bretton Woods may explain the increasing dispersion of the current account surpluses. So that's something we can then talk about after this talk. So, yeah. So Sigga is next, right? Yeah.
So I'll stand up and stand over there, I'm sorry. So basically, this is a, I think, direct progression in many ways from what Gylfi and what we're talking about. And my focus is a little bit more on emerging market economies, and also to think about how the flows change when interest rates are normalized. So what are the risks to economic and financial stability? And this all bases on exactly what Robert Alber talked about the fact that capital flows are the origin of risks, or at least the potential of being origins of risks. So the motivation for giving the talk, in addition to being invited here, is that major central banks are increasing interest rates. And we have a lot of research on capital flows and risks that find that monetary policy stance in major economies has significant effects on capital flows and financial stability. Okay, so I'm moving a little bit away from Gylfi, who talked about the current account. I'm talking about the financial account, which is only, of course, they are by definition equal. Interest rates, normalization in major economy plays hence a huge role in multiple financial crises in emerging market economies. If you read and go really deep, beyond the fact that Soros potentially did some, market manipulation stuff, after the Asian financial crises, normalization of US interest rates. Mexican banking crises, again, normalization of US interest rates. It's always there somewhere in the background, okay? So why are the major central banks tightening? We have a running inflation going on, basically potentially on the back of rates being lowered too much during COVID here in the US, potentially also too lax fiscal policy. Supply chain issues, I don't know, that was the reason we used a year ago, probably not very strong. And then we have a geopolitical situation in Europe affecting energy prices there. In some ways, we have to go back to the 80s for inflations in this range, and for these reasons. And hence, I wanted to go back and think about what kind of lessons did we learn from emerging market economies and the crises that followed there to think about it. So the roadmap for my talk is basically, I'm going to first talk about capital flows and systemic risk. I'm just going to introduce us a little bit to recent literature, move away from the current account to financial flows, split them up and stuff like that. Then I'm going to try to look at what lessons we can learn from banking crisis in the early 80s, and then systemic risk now. Try to potentially make a heat map or some kind of a measure that we can use to figure out, what countries might really be in dire straits now. Okay? So what have we learned? So in the 1995, Goldfan and Valdes showed that changes in the national interest rates and capital inflows are amplified by the intermediation role of banks, and how that basically they showed that when you have capital inflows, like Robert Alber was saying, you have a banking system that usually amplifies the risks throughout the economy. And just like Robert Alber pointed to, the biggest risk is actually on non-tradable prices of goods. So it's non-tradable prices of goods that is the thing that moves along, and leverage. Okay? Calvo showed also in a very, very simple theoretical model exactly this, that basically what you see if you just almost move money out of the place and just say, okay, there's capital inflow and capital outflow, you basically get non-tradable goods increase in price relative to other goods. And what's the main non-tradable good, guys? It's houses. Yeah, real estate, houses. So basically that is a huge sign of there being a capital inflow kind of a spur and overheating in the economy. And on the basis of that, what do? We almost always leverage houses, don't we? Yeah, we don't buy them outright, we leverage them. So then basically the next step was Caballero showing that, okay, we've been trying to look at this from the current account side. We don't get very much statistically significant. We've also been looking at this for complete distribution, No. Let's just look at what happens if we go to the extreme. So not if inflows are 5% more than last year, but rather if they're 10, 20% higher than last year. So he said, we're just going to look at when inflows are excessively high, what happens then? So he looks at what he calls a bonanza, 1 standard deviation away from the average, and thinks about what kind of things happen then. And in addition to that, he said, okay, what about looking at different inflows? What's the difference between an FDI, foreign direct investment, versus potentially just having somebody buy, government bonds in your country, lending to the government, or corporate bonds, lending to your corporates, or like the Austrians did, just lend directly to Hungarian households. So, what are the difference between these kinds of inflows? And he basically finds the surges in both portfolio and other inflows, which are usually direct lending to banking system, increase systemic risk. FDI, on the other hand, is not really that risky. So if the inflow spur is due to the fact that foreigners want to do direct investment in your country, it actually is not a systemic risk and also increases future growth. So not a risk. So basically, we not only have to look at the current account, we have to look at how are we financing current account deficit. Are we doing it through foreign direct investment? Fine. Are we doing it by the government borrowing from abroad, corporates borrowing from abroad, banking system borrowing from abroad? We are increasing systemic risk. Okay? Then, basically, he says that the mechanism is both through increases in leverage and asset price increases. So if you're in the country that is receiving a capital inflow, running the current account deficit, basically, the mechanism of increased risk is through increases in price of non-tradable goods and also increased leverage. Okay. So then Forbes and Warnock expanded this even further and said, okay, if we're looking at capital inflow, the capital inflow like what Switzerland had when they had to actually decouple from the euro is not really very risky. Why? Because it was basically Swiss nationals repatriating cash. So basically, the Swiss franc was going up, and there was capital inflow because Swiss were repatriating cash from periphery of Europe, which was undergoing government debt crisis. Okay, that's not very risky. So basically, Forbes and Warnock point out what we should be looking at is not only the current account and then take the FDI out. We should be looking at actually just liability flows. And what are liability flows? They define them as capital flows that are done by foreigners. We do really not care, and it's usually actually it cushions risk, the flows of our nationals. Why? Because when the risk perception increases, everybody brings their money home, also our nationals. But what do foreigners do when risk increases? They take money out. So what we were interested in is just liability flows. So I've gone from current account down to taking FDI out, and now I'm even taking all flows from nationals. I am just interested in what are foreigners. How big a portion of my current account deficit is being funded by foreigners? Okay, that is the interesting and that is the risky part of it. Okay. Then there was a little bit of literature, a lot of literature, about push-pull. So, if I'm in Korea, for example, is the reason that I'm getting money pushed in and hence running a current account deficit? Is it because of what I'm doing in Korea, or is it because of foreigners? And here it comes really, really strong through that the US monetary policy is a huge factor for any country. Okay? So huge factor for any country. Okay? Then I just want to take a little bit of a jump and think about, okay, we're going through this period now where we have stagflation. We haven't had stagflation since the 80s. And basically, data in particular for liability flows or capital flows are very bad this far going back. So we can't really use our knowledge to run some kind of regressions or some kind of a model to figure out the risks. So we have to do some some just stories here. So here you can see, for example, the Fed funds rate in the 70s to the 80s. And then you have, on top of that, the bars here, which tell you crises in banking crisis in countries, banking and financial crisis in countries. And you can see at the back of the increases in the Fed funds rate, there are a number of crises in multiple countries. And it goes even up to the fact that, I'm wanting you to look at these here, even though I show the whole thing. These here are the crises that come at the end of the Volcker interest rate increases, okay? And then, you know, I give you the names of the countries that had the crisis between 82 and 85. You can see Argentina here, for example, output lost 58%. And you can see also here, Peru output lost 55%. And then we dove even further into it and went like, okay, what's the story behind these countries? And one of the first stories I looked at was Mexico. And you have these papers, for example, this is a Dutch name I can't say. I always say that if you can't say my name, it's fine that I can say his. So from 1994, you see this here. For example, the growth rate of foreign debt. See it. And this is before. See, I'm doing it. See the growth rate before we have the Volcker increase in interest rate. So during the inflation period here, so systemic risk always happens before the crisis. So here they are adding on to systemic risk. There's a huge suction of money going into Latin America and Mexico because basically there's inflation risk in the US and investors are looking for other places to invest in. And they're going here, okay? So there's an increase in leverage here during this time. Huge current account deficit, of course, because that's one of the things that's funding. And you can see the stocks there in millions, just have a huge amount of debt. And what happens? Tell me, what happens in a country that has basically gone from having a stock of, okay, let's go here, 6.25 up to here, 33, I'm going to do 33 before the peso actually depreciates, sorry, I'm going to do that, 33 here. Okay, this is a five-fold increase. What happens when interest rates increase? It can service. So, and I just wanted to point out, in the paper they say, very early realization that foreign debt was a destabilizing factor. It was very early on. It was the external liability debt from liability flows that was the issue. And you know, just another mention, the thing in the red box is the liability flow. Then Chile, also economic reform in the 70s, brings increased growth, bringing down inflation, liberalization of the financial system, you know, pushing what Robert Albert was pointing out to, pushing the floating exchange rate idea, pushing the idea that markets would, you know, just do all these things. And what happened was credit grew rapidly, and foreign borrowing increased significantly. Foreign liabilities went up from 14.4% of total in 1978 to 35.8% in 1982. So basically, as soon as interest rates start going up in the world, they have an unsustainable kind of situation on their hands. Okay? And that's just said in that paper. Basically, higher international interest rate, world recession, lower copper prices, but high international interest rate, always the culprit. Okay? So you get abrupt cut of voluntary foreign credit. Foreigners just, no, we do not want to do this anymore. We can actually have this 17% nice interest rate here. With Volcker, we're going to keep it there. Yeah. So the lessons learned. Basically, we saw actually Latin America learn a lot of lessons from this. And during the next episode of huge capital flows into, or capital looking for yield into emerging market economies, actually most Latin American countries put up what we would call now capital flow management tools. Like put up little bit of walls against all of this. Okay? Not very well received by the OECD, IMF, or anybody else, but they did that. So for example, in the 90s, Chilean authorities introduced a reserve requirement of capital inflows. 20% of credit, basically that their banking system or anybody was borrowing from abroad, had to be deposited in a non-interest-bearing account at the central bank for at least a year. So they're also extending the length of the debt. So there were lessons learned. They stayed there. You know, we didn't learn them. In Iceland, we didn't. But anyways. So, but what do we think is going on now in emerging market economies? Now that we've actually had, if anything, a longer period of low interest rates and increased leverage. And actually leverage has never been as high as it is today in the world, in our world history. Okay? Okay? So what I want to look at here, for example, what are the flows that have been going into these emerging market economies? And you can see I take FDI out, and this is basically the current account minus FDI. fronting of the curve, how that's it. And you can see here I have equity flows and debt flows. And you definitely, first of all, I want to point out this is not a very long series. Like I said, we have to go to stories to go back to the 80s because we don't have this data that far back. It's back to 2004. First of all, here's the global financial crisis. And we had a huge buildup, and in particular in Iceland, there was a huge inflow of funds. And we know it was also the periphery of Europe and a lot of that. This is minimal in comparison to what's been going on for the last 15 years. You see that there has been continuous capital inflow. Note, there the down is of course first quarter 2020, this COVID crisis, everybody running out. They didn't run out for long. They came in actually Q4 again 2020. You can see there are two downward spirals there in a row. So definitely what we see is that there's a lot of flow into emerging market economies. But didn't I tell you before, we also want to just see what foreigners are doing. This is everybody. First of all, I'm going to do a couple of countries for debt and equity flows. And again, this is Korea for debt and equity flows, also Chile for debt and equity flows. So you can go and do this for different countries. You know, of course, if you see a data series like this, you might want to do a moving average. But what about only looking at what foreigners are doing? So these are just liability flows to a number of countries here. You can see these are mostly, I would say, either small economies. You know, somebody got really offended because I said it was mostly emerging market economy, and I have New Zealand here, so somebody got really offended by that. But I think Iceland also has, in capital flow sense, the same characteristics as emerging market economy. But you can see that basically foreigners have been increasingly, and this is flow, so every year foreigners are lending more and more into these economies. Okay, so they're putting on more and more debt, and you can see that that is almost for all of these countries. Yeah.
Tell me,
Yeah.
the axis, the vertical axis, is this in dollars or is it the ratio?
These are actually billions of dollars. Yeah. Yeah.
So I've been
So yeah, I do have a percentage of DNI later. So yeah, that's a problem. Then you know you're not going to see Iceland in there because this is billions. Even though it might be high for Iceland, you don't see that. Yeah. And actually, my problem was that China was actually running a lot of these, and I think I took it out almost everything. But anyway, so individual countries, this is billions of US dollars. Yeah. You can see here Chile was actually, remember the Chilean peso weakened a lot. I don't know if anybody's from Chile here, but they are stabilizing now pretty fast, but they had a huge issue going on. Okay. So these are flows. What about external debt levels? You know, levels, let's go to levels. So here are different countries. You can see external debt here. This is again in billions of dollars. Current US dollars though, at least. But you can see middle income, private and middle income public have grown a lot. What you also see is for a middle income, you get the private debt, which is basically, you get that actually going considerably a lot up. Well, you don't see that as much in these are just low income and then at least. So I would just have EMEs. These are low income, middle and low income countries. So external debt is going up pretty much. When you do it as a percentage of GNI, you get a much nicer picture. Why? Because of course these countries have been increasing their GDP quite fast during this period. But at the same time, so this is going very, very far back. At the same time, you do see here, since the global financial crisis and low interest rates, you get an upward trend in debt against GNI in all of these countries. And of course, we took out 2020 because there's so much decline in GNI that just throws everything out of whack, the data series. Just a couple of countries. I'm looking at Brazil, for example. You see how the debt as a percent of GNI has gone up here since the global financial crisis, and also in Mexico. Not too worried about Mexico, they're already producing countries, so you always have to take a country-specific issues into account here. And then we are considering to try to do this. So what is really the risky part? It is the short-term external debt. The external debt that is actually due in the next 12 months. And we tried to make this kind of a figure here where you have basically external debt as a percentage of GDP, GNI, and then you have short-term external debt. And I would then postulate that these here countries here are the ones that I would be most worried about. So they both have very high external debt and also pretty high external short-term debt. Okay. So as interest rates increase, the question of sustainability becomes an issue. And for these countries, it's even a bigger issue than you would imagine, because we also have a flight to safety, so we have the US dollar strengthening in comparison to the currency of these countries. So you have like a double whammy if you're at the central bank. Okay? So I just for fun, yeah, am I down to 1 minute, 2 minutes? Does anybody want to look a little bit at the UK now? Just a little bit. I have just a couple of pictures. I did this for fun. Also, everyone's talking about the balance of payment issue in the UK. First of all, why? I don't think there's a balance of payment issue to be had. All their debt is in sterling. They can always print it. So, no, not an issue. But look at them. They're actually quite leveraged. And in addition to that, just as actually Gilvis showed you on his picture, they have been running a current account deficit for the last decades. And you can see, I take it on the other side, I do the balance of payment rather than the current account. I'm taking it on the financial account side. But at the same time, looking at the UK liability flows, like I was telling you, that is a good risk indicator. Doesn't tell you anything. Why? Because they have a financial sector that is astronomically big. So that's all the orange things in there. That's the banking sector. So all of a sudden, one bank sells a subsidiary or buys a subsidiary or starts netting out the derivatives table in London instead of New York. You just get all these flows going on. So just take them out. I take the financial sector out. And here you have the public liability flows for the UK. And you can definitely see that there is just a huge inflow of money just into the public sector there, of course, the government. And then also, just looking at net international investment position of the UK, again, it goes down a lot. But you can see here, what country in the world would have, this is not a flow picture, this is a stock picture, would have a stock jump up like this unless they had a financial sector that's 10 times the GDP, that is just throwing something in there. So I took out I did the net international investment position of the UK government. Nice, looks good, yeah. But anyways. And then I wanted to, just for fun, also just see foreign holding of the UK government gilts, because they were the ones running out, if potentially they could. And basically, foreigners hold approximately 1/3 of all UK gilts. But then I just want to say on that side, I know a lot of UK banks run UK gilts fund from Luxembourg and Ireland, so that might be an overstatement, to say the very least. Thank you.
Okay, that Roman is next.
Thank you. No slides for me. It's a pleasure to be here and be with Bob and Sigrid and Gilf. We pointed out to each other earlier that, leaving out, 3 of us have Yale PhDs. We span approximately 50 years in our Yale PhDs. And you could figure out whether there's some common denominator in all this. I guess Sigrid it was not there to be influenced by Jim Tobin, as some of us were, or Bob Triffin for that matter. But okay, my remarks are based upon a longer paper called the IMF, the SDR, International Monetary System, that will soon be issued by the Peterson Institute for International Economics and the Massavar Romani Center for Business and Government at Harvard. And I look at the future for the SDR, and in the context of the International Monetary Fund, and as the principal institution of the international monetary cooperation in the post-World War II period. And that, oversimplifying somewhat, that the institution is built on 2 pillars, at least in the financial area. First, the IMF's resources are pre-positioned So this allows it expeditiously to support a member or the system immediately without having to pass the hat in order to get people to contribute to deal with Mexico, for example. And secondly, as many people forgot until 10 years or so ago, the IMF can allocate special drawing rights, special SDR, to members that enable each holder to borrow foreign currencies directly from other members. And unless the members agree to cancel outstanding SDRs, they are permanent additions to countries' international reserves, unlike currency reserves that once spent disappear from the system. And this central monetary role for the SDR is enshrined in the IMF's Articles of Agreement in an obligation, not currently realized, to make the SDR the principal reserve asset for the system. So I would, here we are in Washington, and the IMF and World Bank are having their annual meeting next week. And so this is my warning shot. In my view, the IMF is at an existential crossroads. The structure of its resource pillar is decaying. The last time members agreed to augment the fund's standing financial resources, its quotas, was in 2010, a dozen years ago. And as a result, the distribution of voting power, which is a function of members' shares of total quotas, has been frozen. That distribution is increasingly inconsistent with global economic realities, and the stalemate over increasing IMF quotas, which I predict will, and fear, I should say, will continue into next year when it's supposed to be resolved once again, threatens to undermine the IMF's legitimacy, and unless corrected, the political and financial underpinnings of the fund will be weakened, and more important, the collective commitment to cooperate through the fund on such matters as exchange rates will fray. And the current structure of the international financial architecture, which has supported 75 years of growth, global growth and prosperity, will be undermined. So much for the quotas. As for SDR allocations, the second pillar, IMF members have failed to cooperate on the potential of the tool. To remind you, the SDR was created to supplement existing reserve assets and support the Bretton Woods regime of fixed exchange rates. Countries established SDR par values with respect to the dollar, which in turn was tied to gold at $35 an ounce, as we've heard from Bob. The structure was supported by the United States being ready to sell gold at a fixed price and to buy it occasionally if other countries needed foreign exchange. But the SDR's establishment came too late to preserve the Bretton Woods exchange rate system. The first SDR allocations were in 1970-72, starting before the United States closed the gold window, and a second set of allocations was made in 1979 and 81 to 91. And it was not until 2009 where another SDR allocation was made. That was agreed in connection with the 2008-2009 global financial crisis, which was followed by a fourth allocation last year in connection with the coronavirus pandemic. So you will note that my remarks share the same starting point with Bob Oliver's. Then we go in a slightly different direction. We've known each other for a very long time, so that works. I focus on the second pillar of the IMF, the SDR, and I advocate or propose an annual SDR allocations, and this would strengthen its role and, I argue, the international monetary system. Just to remind you of the structure, there are very few people who understand the SDR, and most of them don't think they understand it and don't, especially in this town, up there on Capitol Hill. The IMF allocates SDRs to its members in proportion to their paid-in quota subscriptions. They're recorded on members' balance sheets as both assets and liabilities. Countries receive interest on their SDRs and pay the same rate of interest on their liabilities to the extent that the holdings exceed their allocations. They receive net interest and vice versa. Any members who have SDRs can transfer them to other countries in exchange for convertible or hard currencies to meet their external financial needs, or discharge obligations to other members of the IMF or to the IMF itself or other members. And just to give you a number or two, SDRs outstanding are now currently 661 billion in SDRs and 46 billion at the dollar price of the SDR at the end of last month. And in June, the SDR's share of international reserves plus SDRs was about 7%, significantly less than the share of the US dollar and the euro, but 50% more than the next highest share of the next highest currency. So this is a very important reserve asset in addition. The SDR allocations in 2009 and 2021 played a useful crisis management role in mine and most other people's opinion. Many countries, large and small, low income and middle income, use their SDRs through various mechanisms to relax the external financial constraint on their domestic economic policies. As the Articles Agreement intended, the SDR additions to existing reserve assets allowed members to address actual and potential maladjustments in their international payments while avoiding destructive policies destructive of national or international prosperity. So if the IMF, the SDR is going to continue to play its role in addressing economic distortions, its share of international reserves, in my view, should at least be maintained. And the best way of doing so is via annual allocations. SDR allocations are a zero-cost way of increasing international reserves without, importantly, distorting the pattern of international payments by placing burdens on countries, in particular the United States, that issue international currencies. This is where I come back to Bob's argument to some degree. Regular annual allocations would be consistent with the role envisioned in the for the SDR and the international agreements, as I mentioned earlier, that the special drawing right should be the principal reserve asset in the system, not something that's true now. So the case for moderate regular annual allocations has, in my view, 5 main elements. First, SDR allocations have zero cost to the recipient country until or unless it uses this allocation. SDRs are, in a sense, an insurance policy in the form of a potential line of credit with a low premium that only kicks in when the policy holder activates the SDR by transferring to another holder. Second, their cost is also low compared with the positive resort costs of ex-ante reserve accumulation via borrowing from financial markets or devoting real resources to generate current account surpluses rather than augment domestic investment. This is even leaving aside financial crises, of course. Third, from a global perspective, the accumulation of reserves in the form of SDRs involves less distortion of the global economic adjustment process than doing so via undervalued currencies and other policies that boost countries' current account positions. Fourth, when SDRs are used, they do not disappear from the system. They're what we call outside assets in the sense that the assets cannot be extinguished except through cancellation. They move around within the system in contrast with foreign exchange currency reserves which disappear from the system once they're spent on goods and services or to service debts. Finally, the case for regular annual SDR allocations rests on the additional assumption that on average there's going to be a continuing annual collective demand for international reserves. International reserves consist of foreign currencies, as you know, SDRs, reserve positions in the fund, and gold. Notwithstanding Bob's view, gold is generally at the bottom of the pile these days and is excluded from most tallies of international reserves. Reserve positions in the IMF vary with the need for other countries to borrow from the fund. Increases in those positions are generally offset by reductions in foreign currency holdings, except in the cases like the United States or members of the Eurozone, which may provide their own currency, rather than reduce their foreign currency holdings when their quotas are tapped by the IMF. Thus, in the absence of an SDR allocation, the annual change in total holdings of foreign currencies is one proxy for the annual demand for international reserves. Now, the annual changes in these holdings have different signs and vary in size from year to year. For example, from the end of 2013 to 2021, the total increase was 1.2 trillion, an annual average of about $155 billion. Holdings actually declined in 4 of those 8 years. On the other hand, from the end of 2016 to the end of 2021, the total increase was 2.2 trillion, an annual increase, average increase of 440 billion. Holdings rose in all but 1 of those years. Prior to the allocation last year, the IMF staff projected a 13% increase in the global demand for international reserves over the next 5 years. The midpoint of that range amounted to about $600 billion a year, and the allocation in 2021 covered about 40% of the total combined increase. And during the remaining 4 years of this 12th basic period, as it's called, the U.S. Treasury Secretary in principle could vote for another $650 billion, or $175 billion a year, without the prior consent of Congress. You might think that my numbers here are extreme, but Richard Cooper, 12 years ago, suggested the possibility of regular annual SDR allocations of $200 billion a year. It is also possible, but no means assured, that in the wake of the sanctions applied to Russia following the invasion of Ukraine, countries' demands for reserves in the form of assets denominated in national currency will decline, and the attractiveness of a neutral asset such as the SDR will increase. Time will tell. The central question in analyses of demand for increases in international reserves is whether that demand is motivated by the need for additional insurance against an uncertain future, a byproduct of mercantilist policies directed at increasing exports, reducing imports, or running trade and current account surpluses, or a passive response to national and international economic and financial developments. Interestingly, the literature's answer to this question is far from definitive. A few years ago, an IMF staff study found support for 3 hypotheses, slightly different: precautionary demand against current account crisis, precautionary demand against capital account crisis, and mercantilism. However, no one explanation dominated the results, and each explanation was more strongly supported in some periods for some countries than others. So, as a byproduct of what's been going on for the last decade, 12 years, the allocations in 2009 and 2021 should provide some fresh answers to those long-standing questions. This is to inspire you scientists out here to investigate this question. They should shed some light on the role of the SDR in smoothing the global adjustment process. Studies of the recent allocations would deal with the fact that they're made under crisis situations, of course, and a trial period of annual allocations under more settled conditions might shed more light on these important issues. So in summary, regular annual allocations are superior to endogenously generated reserves if they are outside assets that are costless. They're continuously available, they're reasonably liquid, and they reduce pressures on other countries to add to the reserves by running larger current account surpluses or smaller deficits. That divert domestic savings from needed domestic investment and distort the international adjustment process. Thank you very much.
So maybe we start with questions from the audience. Yes?
In truth, I have so many questions, I obviously, that I can't go through them. But let me just say, in the early 80s, there was a group of economists who subscribed to what was referred to then as the reverse causation argument, that inflation was the cause of money growth rather than the other thing. And listening to you all talk, that brings that particular school of thought to mind. When Mr. Friedman and others advocated for flexible exchange rates, it was done in a very specific context of monetary policy. I'm an Icelandic. I was born and raised in Iceland, and I'm old enough to remember when Iceland was essentially under fixed exchange rates, and you had rationing of currency. So regular people could not get foreign currency to travel or buy or anything like that. It was rationed based on insider favors and so on and so forth. And keeping fixed exchange rate in the context of multiple countries pursuing various levels of seniorage. I just don't get it. As an economist, I really don't get the reasoning. Anyway, let me just leave it at that.
I didn't hear anybody talk about fixed exchange rates as being the good regime.
A fixed exchange rate, that was his whole point. Yeah. Wasn't that your point?
I'm sorry?
Do you want to defend yourself?
Oh, I'm happy to. How long do I have?
I think we go until
It
12:30.
seemed to me it was kind of in the background.
How long is this? 45.
So it's a marvelous question. Actually, you asked two questions. I'll respond to the second. I think the question you have to ask is whether the cost of flexible exchange rates to an individual country are worth the benefits. So let's ask that from the U.S. point of view, right? You've asked it from the Icelandic point of view, fair enough. We've lost 3 million plus or minus manufacturing jobs. Our growth rate is slower. We've allowed other countries to determine the value of our currency. And as a result, our trade and our security policy have been deflected from being what I would call ambitious program to a defensive program. Now, I can understand why an individual country like Iceland might want to have a flexible exchange rate. Iceland is one of the smallest countries with its own currency, and it can afford to be a free rider. But we cannot live, the United States cannot live in a world in which everyone else is a free rider. The costs to the United States are just too immense. And so the Friedman argument seems to be, should be turned on its head. A flexible exchange rate is ideal for a country that wants to free ride, but it is extraordinarily expensive to the hegemon. There is no, in the Friedman literature, in the flexible exchange rate literature, there's no demarcation or distinction between the costs and the benefits of different countries. Thanks for the question.
But I think there's an intermediate case. So one is perfectly flexible exchange rates and capital flows. Another is fixed exchange rates with or without capital flows, as you said, in the old days, without capital flows. But you can also have flexible exchange rate and use more instruments, like Sigga was describing Chile. So you use the exchange rate flexibility to adjust to real shocks, like what was lacking in the old days. But you temper the capital flows, which we didn't do before 2008, and caused the financial system to crash. So you can have a tax, a reserve requirement on portfolio inflows. So
You could probably talk about 2008 in Iceland for the rest of the week here.
yeah, or Chile in 1982. It's the same story, more or less.
But look at all the problems in the Eurozone now. That is ineffective.
Well, we have another guy who's
Excuse
asking,
me.
wants to ask a
Yeah.
question, so we should let
Yeah,
him do it.
yeah, we should go, take a second question. Oh, you were the number two.
I got it.
Okay, yeah,
Well, just following up on that, especially what Sigurdur was saying, it seems like there was an experiment for a while with capital controls. And even though at first there was a lot of shock, then there were some economists that were kind of coming around. So if we're saying capital flows are the main problem, I think there is a role for capital controls in the future?
So first of all, I wouldn't want to call them capital flows. I call it capital flow management. And I'm usually always talking about managing the accumulation of systemic risks. So it's basically capital inflow management. While a lot of economists are always talking about crisis management tool, which is basically locking the flows in once they've come in, which is what I would say capital controls. But yes, I think Latin America has shown us, even now in the normalization rates through 2013, 14, 15, how Brazil actually stopped some flows into their stock market. Chile was stopping also flows into the banking sector. And actually Iceland used capital inflow measures as well. I think this is definitely necessary. And I would just point to the seminal talk by Helena Rey, where she basically said that the trilemma is not really a trilemma, it's a dilemma. For most countries, you do not have independent monetary policy, because if you would be using independent monetary policy, you would be going through many financial cycles, which are very, very costly. And research just shows, if you go through a financial downturn, you don't not only have much more decline in GDP growth than in any other kind of economic downturn, it's actually longer lasting, and you will not get back on your previous growth path. So, there is incentives to do this. And to tell you the truth, the OECD has been the entity talking about free capital flows. And for example, Korea had a macroprudential kind of a tax on inflows, where OECD called them in front of them, I think, multiple times to try to tell them to take it off. And Korea just disregarded it, and they maintained stability. They learned lessons from the 1998 crisis, which we did not. We called it crony capitalism. But we should have learned the lessons of the international financial system, which basically Bob Albert was telling us about.
Yeah, I bring that up. I'm actually kind of agnostic about it a little bit. But, to me, fixed exchange rates are kind of blatantly unrealistic. I don't see that Nixon
I just,
never been.
talking about these corners is just ridiculous. Nobody has fixed exchange rate, nobody has flexible exchange rate. We're all in some kind of management. How often does the Icelandic Central Bank intervene in the currency market? Often. We've had capital controls since 2008 on outflows and then on inflows. Come on. We even have capital controls through the fact that we are not allowing our banks to have, they have to, for example, if they collect deposits, they have to have full reserves against foreign currency deposits. That's capital inflow management. Yeah. Just you do it, it's basically trying to remove systemic risk.
All right, any other questions?
I'm always preaching. I'm sorry, guys.
I would have a question directly from Julie, to Professor Plenary. You mentioned that you took out, just to make sure I understood it, the real estate part of has to do with flows. I was wondering how, if before doing that, you looked at how much this was making up, because even tier 1 countries are experiencing a lot of foreign investment, real estate going out, which means immediate inflows, but then continuous and permanent outflows. How does this account?
Are you talking about in particular New Zealand, where the Japanese housewives are buying apartments? Yeah. So no, I didn't take out real estate, or the UK, where the Russians are coming in. But no, I didn't take real estate. I took out foreign direct investment. And foreign direct investment basically means that the flows are stuck there. They cannot turn around and run out. So they're a little bit more stable and usually do increase growth potentials. But you do have, and most foreign direct investment is in productive things within the economy. But you do have these exceptions, for example, in some countries where there has been inflow into mortgages, real estate market. And they have actually tackled them in a little bit different way through second lien mortgage rules, LTV rules, and things like that. But they are also not very, beneficial, but not in the same way. So the systemic risk from capital inflows is the fact that they can have a sudden stop and run out. Taking your currency with you, taking price of non-tradable goods with them, which will just plummet. But the problem of these inflows that you're talking about may be into real estate market. That's more you potentially are creating an asset price bubble, which will exacerbate any kind of systemic risk. So that's a little bit kind of different kind of bubble. It's not the risk of the sudden outflow.
Okay, I think
Yeah, sorry.
that may be the last question, but
Sure, technical question for the, Iceland guy.
yeah,
So-
he spent a year there in 1988.
Jag har varit Iceland. So the question for the two Icelanders is this. Both of you use very sophisticated unsupervised machine learning in your analysis. I wondered whether, especially Geofeed with the principal components analysis, technical question, have you considered using distance measures and clustering with respect to your data?
Yeah, that would be a good idea to.
Okay.
Paul, yeah, thanks.
If you haven't done it, I'm just volunteering to help you with it.
Co-author with us.
The reason I suggest this is because both of you are talking about similarities among countries. And whereas PCA can give you the eigenvectors that give you the average of the entire group, and so shift the central tendency, the other half of unsupervised machine learning, which is namely the clustering analysis, can show you the dispersion and then the multiple centricity, centers of attraction within the data. And that's just a suggestion. I wonder if you've done it yourselves. And
I haven't done it, but
okay,
you want to co-author? We can do that.
I'll bet you money
But-
somebody in his office is trying.
But don't you need more countries? If the historical data is just 18 countries. With
I think even with, I have done clustering with commodity time series with as few as 20. And so using exactly the same code, substituting macroeconomic balance of payments data, there's no reason mathematically why that should not yield the same kind of result. I found, for instance, that among metals, just to give a classic example, aluminum is considered a base metal like nickel or tin.
Right.
Frankly, it acts much more like gold, silver, palladium, platinum, the classic precious metals. So if you can let the math apply to the unsupervised learning that you've already performed, I think it would be extremely interesting to see how countries cluster and whether Iceland is really more like Ireland or Portugal on one hand, or whether Iceland is as far away from the United States as I think Sigurd's analysis suggests.
Yeah, that's a great idea. Before we end, so our two wise men, do you want to have the last word?
We're glad to listen to you youngsters. Speaking for myself, we're glad to listen to you youngsters.
Yes, you're fine. All right. Okay, so thank you for coming.